action. Mark Matthew joins us. Mark, it's just one of those moments where the price action is forcing you to perhaps ask a different question. Are we missing on something? Are markets telling us something which we cannot figure out today?
Well, as you just told us, the markets have been in this incredible rally. They haven't looked back. And I must say, it is incredible because in the past occasions when you have had very sharp corrections in the S&P, I can cite 3 years technically that look very similar. They were 1962, 1974, and 1987. Very fast collapses in the market. And even after those, it always needed to build a base that took between 2 to 4 months. And I think that's what almost everybody expected this time too. We didn't think the base would be the 23rd of March and we'd never look back. So the explanation must be the liquidity that you also very aptly described. And I think that with these incredibly low interest rates and all of the fiscal and monetary stimulus, the market is willing to look through the lockdowns into next year and even into 2022. And if you do that, if you follow what the consensus assumes, which is 25% earnings growth for next year and 15% earnings growth for 2022, then actually the S&P is a little cheaper than its long-term average. So those are all the reasons I think that we can look back in retrospect and see now why it happened. But certainly if I was talking to you, if we could rewind the clock and it was the 23rd of March, I never would have saw this coming.
Well, Mark, no one would have thought this would have come. So, Mark, for an ordinary investor who, let's say, follows you or follows Buffett or a Sam Zeel or a Howard Marks or Stanley Druckenmiller, these are billionaire investors who've made not millions, but billions by getting the market cycles right. All these so-called famous investors are saying, bulls, you need to be careful. This market ain't going to sustain. And guess what? After the Berkshire Hathaway AGM, Dow and the S&P has only gone higher. So are the old-timers getting slightly rusty? Or all of us eventually will realize that these excesses in the market will be tested and you should now take some cash, sit on the sidelines because bulls are not going to have the last laugh?
Well, first I would say I can't put myself in such illustrious company, so please don't include me with them, and I'm not a billionaire. The second thing I would say is that just to choose the most famous one of the people you quoted, Warren Buffett, the reason he said he didn't participate in this rally was because he didn't understand what was going on. He's not an epidemiologist, and one of Warren Buffett's credos has always been he won't buy what he doesn't understand. So I think it was entirely logical. Nobody knew back in March what the progression of this virus would be. Even the epidemiologists had extremely wide and divergent views. But increasingly now, I think there is evidence that it follows a certain pattern, a certain seasonality in countries, which is typically a big wave of about 1 month. And after that, it starts to slow down. And we are also hearing, I have to say it's more anecdote than data supported, that the potency of the virus is diminishing certainly in Europe. There's been some talk about that. In Italy, for example, they're saying that we're just not seeing as many people in ICU. And the swab tests that we're doing are coming back with much lower viral loads than they were back in March and April. And you can see even that cases globally are still rising. New cases globally are still rising. Deaths on a daily basis are falling. So I presume that the one big part of this rally has been that the virus, in fact, has been shorter in duration than the market had feared. And now we're seeing economies open up. And so far, of course, we could be very wrong, but so far there's been no big second wave. There have been localized cases in places like Korea, for example, but no massive second waves. And that, I think, actually will continue to take the market higher. The reopening plays, the laggards retail, financials, industrials. Those are now the ones that are on the move, and emerging markets, I might add.
Okay, fair enough. Let's talk about, really how one should approach this strategically as well, Mark, when it comes to India. What would you be most bullish on, given the kind of strength of the rally that we've now seen? Until now, we were looking at pharma, which continues to look strong. Would you also add more into the portfolio names that are in sync with global markets, or would you look more for domestic strength?
Well, one thing that I think has been quite consistent around the world has been the resilience of sectors which one saw as either being beneficiaries or least impacted by the virus. They were the outperformers. Technology, first and foremost, because technology is a big beneficiary of this. The virus has accelerated digitalization. Healthcare, as you just mentioned, another obvious beneficiary. But as the virus, and new cases are still rising globally, but as it's ebbing in Europe and the United States and many countries here in Asia too, it's gone down to very statistically unimportant levels. The catch-up plays are the consumer and industrial and financials, as I just said. And just intuitively, in my opinion, those will be the outperformers in India once people relax a little more about the virus. And you can't do that yet because, of course, it's still a big problem in Maharashtra and a couple of other places. But just looking at the progression in other countries, I think it's fairly safe to say that you will be coming to the end of it sooner rather than later. Therefore, those catch-up plays might be the appropriate things to start buying now while they're still low.
Okay, fair enough. When it comes to the catch-up trade, again, anything with regards to a more structural shift in the economy that you're looking at, or would you stick to the higher momentum names that have already been, seeing a bit of a roller coaster when it comes to the markets?
Well, I know I'm going to sound like I'm cheating, but the answer is both. So they're very different. The companies that benefit from this were already benefiting from a move toward digitalization anyway. And I just cited technology, but there are, that's sort of the most obvious one, Netflix and Zoom and all the companies that people have been using more of. And we would have increasingly used more of those anyway without the virus, but it's accelerated it. And those are long-term structural stories that I think, should be, I don't want to specifically cite those two companies, but broadly speaking, technology will benefit from the further digitalization of economies and societies throughout the world over the next 5 years. But that's a 5-year story. And what I would say, like the 3-month story, is the catch-up of beaten down hospitality names, malls, food and beverage, that kind of thing, because inevitably they will re-rate as people can see the light at the end of the tunnel with the virus. And it started happening in the US and Europe, and I think it's only a matter of time before it happens too in India. But those are two very different buckets. One is a long-term structural bucket, and another is a sort of short-term trade on the economy reopening.
Right. Mark, just a little concerned about the kind of social unrest that one is seeing across states in the United States, and whether or not it could have a bearing on the upcoming US presidential elections and thereby on the equity markets and the dollar movement as well.
Well, my first point is that if you look back at previous riots or protests in America, this one is the first that's really been, well, I think you could say this is the biggest, but there have been previous ones. Ferguson, Missouri in 2014, the Los Angeles riots in 1992. There were big riots in Miami in 1984, I believe it was. Anyway, there was never any change in the economy or consumption patterns as a result of these. And I already feel actually the rioting side of this is calming down now, because they're arresting the leaders. Every day they arrest about 20 or 30 of the leaders. And most people won't break down a window to run in and steal things. They need a leader to do it. So that as they take out the leaders, there's less of those. The protesters who are more, sentimentally, they're very upset about what's happened. I think also seem to be becoming a bit less passionate because the police involved in this are being charged with murder, which is a very, very tough charge. So I think they like that. But anyway, as far as it impacts the election, way it works, I think, is it's actually going to boost Donald Trump's chances of winning. And I know that sounds strange, but you have to put yourself in the shoes of the voters in those swing states in the Midwest. They don't like looking at their cities being looted and pillaged. And they feel that the Democrats are being soft on the people doing that. So right now, the betting websites are showing that Joe Biden has a small lead over Trump, and that's because of the virus and the mishandling of the virus by the White House. But the Democrats have to be careful, because if they look too much like they're pro-protester, pro-riots, then their lead could diminish.
Then do you get most bearish on, Mark? Because, history has told us that you're never wrong fighting the Fed, or for that matter, being bullish on the US dollar. Do you think that call stays?
Well, the big thing that's happening in the markets now is the change in direction of the dollar. And to really be sure that this is a trend change, I think we need the dollar to take out its low of March. We're moving in that direction, but the dollar weakness is nectar for Asian markets, including India, and emerging markets in general. And that, I think, is probably one of the biggest things happening in the market right now. And it will ensure that markets continue to rise in Asia and emerging markets.
Okay, fair enough. Mark, what about, in terms of, let's talk about commodities for a moment. Crude has given us its own shockers this year. We've got an OPEC meet coming up. How do you see that playing into the overall equation? So commodities and the dollar, for a change, is actually seeing a bit of a blow. How do you see some of this affecting the global dynamics going forward?
Well, it's very clear that when the dollar goes down, most commodities go up. The simple reason is they're priced in dollars. So when the dollar goes down, you can buy more of that commodity. With oil, there's the OPEC plus negotiations, which don't look like they're going to be very successful. So I'm not sure if we're going to see many more cuts. But on the other hand, with economies reopening, we will see more demand. So our own forecast is for the oil price to be back in the it's more $40 to $50 level by next year. And beyond that, we're not big fans of oil, simply because we see the alternative energies becoming very economically viable. And don't forget that shale becomes increasingly economically viable. In fact, a lot of shale is even break even in the United States at about $25 a barrel now. It was only break even at about $45 a barrel just 2 or 3 years ago. So the technology continues to improve for shale. On balance, therefore, we see a recovery to about $40, $50 next year, but then long term, there's no reason why the oil price should go up after that.
Okay, and when we're talking India, would you go beyond the frontline names? Would you start to look at broader markets given the kind of activity that we're starting to see?
Well, I'd liked the mid caps last year, so I can't change my mind. Although clearly they're more impacted by the lockdowns than the big companies, but they are where the value is. And of course, this whole idea about value has been so disappointing and elusive. And anybody who was brought up in financial analysis was taught to be a value investor. That's what you're supposed to do. It's been so disappointing. I think we're going to get a value rally, and maybe it lasts around 3 months. But longer term, the thing that hurts value is that interest rates are going to stay low, and it's clear that when interest rates are low, value underperforms. The logic, I think, is simply that when rates are low, it's because economic growth is low, and when economic growth is low, people go out of their way to find growth and pay up for it. But anyway, I think that there is a value/cyclical rally. It's already started in the West. I think it's going to come here in Asia too. It's a reopening rally, but longer term it will be constrained by the relatively low rates of economic growth and low interest rates.
Okay, Mark, great having you on the show, and good to speak with you as always.